We're used to thinking that in finance, speed is everything. The quick trade, the instant cash conversion. But what if the smart money in 2025 is actually moving towards things you can't sell quickly?
That certainly flips the conventional wisdom on its head, doesn't it?
It really does. And that's exactly what we're diving into today, this growing trend of lending against illiquid assets. Now, for you, if your portfolio includes things like, say, real estate, private equity stakes, maybe even some unique collectibles, well, this shift in lending could be pretty significant.
It's a fascinating development. It really offers valuable insights into how wealth is being leveraged in new ways.
Exactly. Our exploration today, it's based on an article from privatebanking.one. The title is Illiquid versus Liquid Assets, Why Lenders Prefer Slow in 2025. It's written by Peter, April 24th, 2025.
Right.
And our mission really is to understand why this is happening, this apparent preference for slower assets. We want to break down how these deals work, the mechanics, and what it all means for investors and borrowers like you. Trying to keep it clear, avoid getting lost in the jargon.
Makes sense. So where should we start? Definitions, maybe.
Good idea.
Yeah.
Let's unpack what we actually mean by illiquid versus liquid assets. What's the fundamental difference there?
Okay, so at its core, it really boils down to how easily and quickly you can turn an asset into cash without, tanking its market price. The article lays it out quite clearly.
Right.
Illiquid assets, sometimes called non-liquid assets, they generally take longer to sell. And it often involves quite a bit of effort, like evaluation, negotiation. I'm thinking about real estate, right? Commercial or residential.
Yeah, selling a building isn't instant.
Exactly. Or investments in private equity, venture capital. Then you've got things like art, antiques, collectibles, even big ticket items like yachts and private jets.
Wow.
Intellectual property to patents, trademarks, and shares in private companies, before an IPO. That's all illiquid.
So the common thread is you can't just hop online and sell these instantly on some big market.
Precisely. They often lack that ready, transparent pricing you get with, say, stocks. The pool of buyers might be smaller, and the selling costs, legal fees, broker commissions, appraisals can be pretty hefty.
Okay, got it. That paints a clear picture. So flip side then, what makes an asset liquid?
Well, as the article explains, liquid assets are the ones you can convert into cash quickly and easily with minimal impact on their value.
REITs.
Like cash itself, obviously, money in checking or savings accounts, publicly traded stocks and bonds, money market accounts, mutual funds, government stuff like treasury bills, and ETFs, exchange-traded funds.
Okay, so the key words there are high marketability, transparent pricing, low transaction costs. You can buy or sell fast without messing up the price too much.
Exactly right. Now, here's an interesting question the article kind of gets at. Why do high net worth individuals, HNWIs, often keep so much wealth tied up in these less liquid things? It seems a bit counterintuitive if quick cash is always king, right?
That's a really good point. Why would you hold so much in assets you can't easily cash out? The article points to a few key reasons, and it's not just about, owning fancy stuff, is it?
Not at all, no. A big driver is actually the potential for higher returns. You often hear about these illiquidity premiums. Basically, you might get paid extra yield for tying your money up longer.
Ah, okay.
Plus, many of these assets, think art, private equity, they don't always move in sync with the stock market. So that gives you diversification, spreads your risk. The article even mentions, I think, that private equity illiquidity premiums in 2025 are averaging quite a bit higher than public benchmarks. Makes holding them worthwhile long term.
So better potential returns, and it helps balance the portfolio against stock market swings. Makes sense.
Exactly. And then there's the non-financial side. There's often a sense of control, maybe tangibility. You can influence a private business you own, or you physically possess the art. It's different from just owning a stock certificate.
Right, a different connection.
Tax planning, too. Holding certain assets can help defer capital gains or fit into estate planning strategies. And sometimes, as the article notes, things like a family estate or a yacht or a specific art collection, they're more than just investments. They're part of someone's identity, their legacy, maybe a passion.
So much more than just numbers on a spreadsheet.
Yeah.
But this loops back to the core issue, right? These individuals have valuable, illiquid assets for good reasons, long-term growth, personal connection. But what if they suddenly need cash? Selling might be the last thing they want to do.
And that's the gap that's being filled. That's why we're seeing this shift in lending. Private lenders, alternative credit providers, They see this demand for liquidity without forcing a sale of those long-term assets. They're stepping up where maybe traditional banks were a bit more cautious.
Okay, so this is where it gets really interesting. Why are lenders now, in 2025, more willing to take on these slow-moving assets as collateral? The article gives a few reasons.
Yeah, one really compelling one is this idea that scarcity can actually mean security, in a way.
How's-
Well, unique assets, a rare painting, a specific jet model, prime real estate in a top location, they tend to be less tied to the daily swings of the broad market. Their value might be complex to figure out, sure, but their rarity can offer some stability when things get volatile.
Ah, interesting.
Of course, the article stresses you absolutely need solid appraisals and good insurance. That's critical.
So their lack of easy trading actually makes them more stable collateral in some ways, because they're not bouncing around like tech stocks might be.
That's the idea. And then there's the demand factor we just talked about. Borrowers want this flexible liquidity. They need cash for opportunities, taxes, whatever, but don't want to sell their long-term holdings. So lenders offering this are winning business.
It's about meeting a specific client need with a tailored solution.
Absolutely. And don't forget the evolution of structured finance. Lending structures today are much more sophisticated. They figured out ways to protect the lender without immediately having to force a sale if things go wrong. The article mentions a few key tools here.
Like what, specifically?
Well, special purpose vehicles, SPVs, they're used a lot to actually hold the asset. The article points out these are important because they create a sort of bankruptcy remote bubble around the asset. It shields the lender's claim if the borrower has other financial troubles. Very useful for these complex assets.
Okay.
Then you have things like trust and custodian agreements. These basically secure the lender's rights over the asset and make enforcement easier if needed. And control agreements, these limit what the borrower can do with the asset, set out loan terms, and define exactly how the lender gets repaid if there's a default.
So lots of legal layers to provide a safety net for the lender, even if the asset itself isn't easy to sell quickly.
Precisely. And finally, the article points to the bigger economic picture, the hunt for yield. Returns on traditional bonds and loans have been pretty low, right?
Yeah, compressed yields are a big theme.
So lenders are looking at these more complex, maybe higher risk, but potentially higher reward illiquid asset classes. The article specifically calls out private credit funds, family offices, alternative asset managers as players moving into this space.
Right, so it's a mix of borrower need, lender innovation, and the search for better returns driving this whole thing. Okay, so we understand the why. Let's get practical. How does lending against illiquid assets actually work? What are the nuts and bolts?
Okay, the article breaks it down. First, the types of loans. You've got asset-based loans directly secured by that specific illiquid asset. Then bridge loans, usually shorter term, maybe bridging to a planned sale or refinancing. And lines of credit, more flexible drawdowns, again secured by the illiquid asset.
So different structures for different needs. What about how much they'll lend? I guess it's not like getting a mortgage where LTVs are pretty standard.
You're absolutely right. Lenders are definitely more conservative here. The loan-to-value or LTV ratios vary a lot depending on the asset. For art, maybe 30% to 50%.
Yeah.
Jets and yachts, perhaps a bit higher, like 50% to 70%.
Okay.
Real estate, often a bit more, maybe 60% to 75%. But something like private equity stakes, which are harder to directly collateralize, you might see LTVs around 40% or even lower.
Those are definitely lower LTVs than, say, a standard home loan. It really highlights the perceived risk and complexity.
It does, and lenders add more layers of protection, too. The article mentions things like taking formal legal title or putting liens on the asset. For physical things like art, custody agreements are common. The art goes into secure storage.
Makes sense.
They'll always require comprehensive insurance and often include valuation covenants, meaning the asset needs to be reappraised periodically. For things like planes or yachts, you might even see performance covenants, making sure they're maintained properly.
So a whole toolkit to manage the downside. But the article still flags valuation and liquidity as the core risks, right?
Absolutely. The appraised value isn't always what you'd get in a quick or forced sale, and how long it takes to sell can vary hugely, especially in a downturn. Sophisticated lenders manage this with those conservative LTVs, using specialist third-party appraisers, and sometimes having options to revalue the asset during the loan term.
It sounds like a very specialized field. Who are the main lenders doing this kind of thing?
Yeah, it's a bit of a niche, but growing.
Ah.
The article identifies a few key groups: Private banks, especially those serving ultra high net worth clients, are active. Then you have specialty finance firms, dedicated shops for aviation finance, art finance, marine finance.
Right, the specialists.
Family offices are increasingly involved too, sometimes lending to their peers. And as we said, private credit funds are jumping in, looking for those risk-adjusted returns. The common thread. These lenders tend to be pretty agile, creative, and have deep expertise in these unusual asset types.
The article even had some great case studies, didn't it, to make it more concrete. Can you walk us through one or two?
Sure. There was one about a tech founder. Needed $5 million working capital for his company. Instead of selling his private equity, he used his Gulfstream G650 jet as collateral.
Wow.
The jet was put into a trust, strict maintenance rules in the loan agreement. The lender gave him the cash at a 50% LTV.
So he got the capital without selling his shares or his jet, at least for them. Smart.
Exactly. Another one involved art. A collector had a $25 million post-war art collection. They needed $10 million for a real estate deal.
Okay.
So they pledged the art collection. It went into secure storage under a custodial agreement. The loan let them buy the property without selling the art and triggering potentially big capital gains taxes. They kept their collection intact.
That's a really clever way to unlock value without actually selling.
It is. And one more quick one, a 60-meter super yacht. The owner used it to refinance some expensive debt, got a $12 million loan, 55% LTV, interest only for 24 months, after a full inspection and valuation, of course.
These examples really show how it works on the ground. Very helpful. But like any finance deal, there have to be risks, right, for both sides.
Absolutely. For the lenders, the big ones are valuation risk, getting the value right on unique assets, legal risks dealing with international assets, complex ownership, fraud risk, sadly, and just the sheer difficulty of enforcing the loan and selling a niche asset if the borrower defaults. It's complex.
Yeah, definitely need specialist skills for that. What about risks for the borrower?
Well, typically these loans cost more. Higher interest rates, more fees, legal, appraisal, setup compared to borrowing against, say, stocks.
Right.
The LTVs are lower, as you said, so you get less cash relative to the asset's value. And the biggest one really is the potential loss of a unique, maybe personally important asset if you can't repay the loan. The article really hammers home the need for due diligence for everyone involved.
Clearly not something to jump into lightly. The article had a useful FAQ section too, summarizing key points. Anything from there worth highlighting again?
Yeah, a few good refreshers. It really emphasizes that core difference between illiquid and liquid time to sell, potential price discounts for illiquid. It explains why some assets are liquid deep markets, lots of buyer-sellers, price transparency. Makes sense.
And it confirms, yes, you can use these hard-to-sell assets as collateral, but lenders need those safeguards appraisals, insurance, conservative LTVs, the SPVs, custody agreements.
Exactly. The FAQ notes how lenders adjust LTVs based on the specific asset's liquidity risk. It also reinforces how structures like SPVs protect the lender while letting borrowers tap into that value. And it acknowledges the higher risk for lenders, but explains it's managed through careful vetting and those lower LTVs.
The FAQ also lists clear examples of liquid stuff, cash, stocks. And it clarifies that most mutual funds and ETFs are liquid, but you might find exceptions based on what they hold or redemption rules.
Right. And importantly for borrowers, it revisits why you'd avoid selling illiquid assets taxes, messing up long-term plans, maybe getting a bad price. It also flips the coin, noting a risk with liquid collateral. Market crashes leading to margin calls. That's less of an issue with the relative stability of many illiquid assets.
Okay, so pulling it all together, it really does feel like a genuine shift in how lenders are looking at assets in 2025.
It seems so. This growing acceptance, this strategic use of illiquid assets in lending, it's a significant development. It offers benefits for borrowers getting cash without selling prized possessions. And for lenders, it's a chance for better yield, maybe more stable collateral in some ways, and a way to stand out from the crowd.
It's a fascinating change, moving past just focusing on instant cash. And that final thought from the article really sticks with me. Slow is no longer a weakness, it's a signal of strength. Kind of sums it all up, doesn't it?
It really does. It suggests a deeper look at value, recognizing the stability and long-term potential that some of these slower assets hold.
Well, this has been a really insightful deep dive. Hopefully it's giving you a much clearer picture of this whole trend around illiquid asset lending. And look, if you found this useful, if you want to keep up with trends in asset-based finance, maybe AI and finance too, please do consider liking and subscribing. Your support really helps us keep making deep dives like this one, bringing you these kinds of insights.
Yeah, understanding these shifts can really give you an edge. It encourages looking beyond the usual assumptions and seeing new ways to work with different kinds of wealth. Definitely food for thought.